Hi everyone, welcome to today's video. So on today's video, we are going to cover a very important concept around how to navigate or how to prepare for a bear market. You would say, Akshat, you are scaring us. You have been advocating investing in the stock market, crypto market, this market, that market, and now you're sitting and you're talking that, hey, we are going to witness a crash. Actually, the crash is going to happen 100%. It will happen at some point. No one knows whether it will happen 6 months from now or would it happen 6 years from now. We cannot be sure. No one can be sure. So this is a very important point, but we need to prepare for a bear market, and more importantly, we need to understand how not to lose money during a bear market. Now here is a tweet that I made that encapsulates the sentiments of how you can trade in a bear market. Actually, it is not too different from a bull market. Fundamentally speaking, provided that you are an investor, not a trader. So what I'm trying to say is that if you are an investor and if you have picked up fundamentally good stocks even before a bear market, and if for some reason your portfolio shrinks by 50%, it will go up back, right? That is 100% going to happen. That has happened after every single crash. That crash happens, your portfolio takes a hit by 40-50%, then your portfolio shoots up again by 50-60-70%. Now let me help you further consolidate this simple point by giving you the example of the recent crash. That in 2020, coronavirus hit, my portfolio took approximately a 50% dip. I'm saying my portfolio took a dip. It does not mean that I booked a loss. I did not sell even a single share. Now, let's imagine that I was sitting on a portfolio size of, let's say, hypothetically speaking, 1 lakh rupees. Coronavirus came, my portfolio shrank and I was sitting at 50,000 rupees. I understood that, hey, this situation will improve at some point. I don't need to panic. I don't need to do anything weird. As long as I'm holding fundamentally good stocks, these stocks will bounce back. It will happen. It might happen in 1 year. It might happen in 2 years. It might happen in 3 years, but it will happen. And there is no need for me to engage in panic selling. Now you will say that, okay, you know what, Akshat, everyone talks like this. You're also talking like this. So what's the difference between you and them? Give us like more concrete evidences. So this is what I'm going to precisely help you understand through this video. Why is it that market will not stay low? You can bring Nifty from 12,500 to 7,000, but you can't permanently keep Nifty at 7,000 forever. That will just not happen. Nifty will bounce back and it will cut its previous peak. This is the central message. If you are able to keep a track of and you are able to hold your nerves during a bear market, you will survive. Not only will you survive, you will see very strong gains on your portfolio. So let me cover these points in slightly more elaborate and detailed manner. Please watch the video till the very end, because if you don't watch the video till the very end, you will understand half the things only about the bear market, and then you might act in a very irrational manner when the panic situation hits. So very important, please watch the video till the very end and also press the like button. That will make me super happy. Now let me speak in 4 simple points about bear markets. The first simple point is around the basics of what a bear market is. When someone says that, hey, we are in a bear run, right now we are in a bull run, but if someone says that, hey, we are in a bear run, what does it exactly mean? So there are 3 types of corrections that happen in a market. The first is a minor correction, the second is a major correction, and third is a deep correction. So these are the 3 types of corrections that happen. There is no standard definition, but I am just bifurcating it for your own understanding. So a minor correction happens very frequently. For example, if the market corrects by 5 or 7%, it's a minor correction, right? These kind of corrections can happen intraday also. So 5-7% correction in the market is considered to be a minor correction. Super simple to understand, and this happens very frequently. The second is sort of a major correction. So major correction or correction. In US they call it correction. So correction usually is meant when the market corrects by more than 10%. So between 1980 and 2018 in the US market, the market has corrected 37 times. So in 38 years, it has corrected 37 times. That is that the market has roughly corrected by 10% almost every single year, right? So this is a very frequent phenomena again, that even major corrections happen. Now a bear run happens when the market corrects from its recent peak by more than 20%. That is roughly what is considered to be the definition of a bear run over a sustained period of time. Now bear run can also be categorized when there is just general negativity around. Everyone that you're talking to, they are like super panicked and everyone is stressed that, hey, market is losing this, market is losing that everyone is just super stressed out. Now put yourself back in March, April 2020 and ask yourself the question, when the market tanked from approximately 12,500 levels Nifty to 7,500 levels, everyone was panicking. Everyone was now imagining that the Nifty will absolutely go to zero and I will start my investment journey when Nifty hits 1,000 points. Guess what? Those people are still waiting for the Nifty to come back to 7,000 levels and then they will start investing. They have not invested when Nifty was 7,500. Many of my friends did not do that because they were always imagining that, you know what, Nifty is now at 10,000. Let it come back to 7,500, only then I will invest. They kept on waiting. Nifty is almost hitting 17,500. They are still sitting tight. So just to quickly summarize that there are different types of corrections. A bear market is characterized by 20% correction and there is general pessimism. Everyone is super scared. They don't want to step foot in the market. So this is what a bear market means. Now here is a very interesting chart for you. I will request you to zoom out and look at it very, very closely because this is a historic indicator and a very important indicator that you need to keep in mind while analyzing how bear runs are performing nowadays. So if you take a look at March 2000, this was the dot-com bubble burst. It burst towards the end of 1999 and the market corrected by 49%. You can see this via the blue line, right? Now the bear run existed for 31 months. That's the purple line. And it took 56 months, almost 4.5 years for the recovery to get completed. What it simply means that back in March 2000, that bear run, when it started, so let's imagine that you were having Microsoft stock, hypothetically speaking, at $100. Then bear market hit, your stocks got corrected by a lot. Then for Microsoft to come back to that $100, it took almost 4.5 years. So of course, this is a very scary period and that is the reason why bear markets are very, very scary. So this was back in 2000. Now, then what happened? If you take a look at the 2008 financial crisis, now there the market corrected by 56%, right? 56%, that's huge, right? And the length of the bear market went down. It only lasted for 17 months and the recovery period was 49 months or roughly 4 years. Now we recently witnessed a bear market and it was the recent 2020 Corona pandemic. Now the data has been presented for February 2020, right? So this data is not complete, so to say. But the market corrected by approximately 40-45%, right? At least the Indian market corrected by 40-45%. The market recovered very quickly. The market recovered literally in 6, 7, 8 months. Now, why am I telling you this historic fact and historic story? There is a very important reason here that now, if you actually take a look at S&P 500, right? The US stock market index, so to say, if you compute the weight of top 10, 15 companies, which comprises of FANG companies, those make 25% weight. The top 5 S&P 500 companies make like approximately 20-25% weight of the entire 500 portfolio of stocks. Now, why is this fact so important? Because nowadays there are more and more companies that are tech driven. What that does is that the recovery also happens very fast because tech stocks are very volatile. Now let me help you understand that point further. So let's compare the 90s dot-com bubble which burst in early 2000s. Now here, what type of companies used to exist back in the 90s? These are mostly heavyweight companies like Ford, right? Many automobile manufacturers, industrial companies, etc., etc. There were very few big internet-based companies. Now if you take a look at companies like Ford, or any automotive firm or any industry-oriented firm, what happens to their PE? Their PE actually rises very slowly and falls also very slowly. These are less volatile companies. For example, if I ask you that, hey, is HUL more volatile or a company like TCS more volatile? Your answer will be HUL is less volatile. It is an industry-oriented company. You can estimate the business, so on and so forth. But now what is happening as we are sitting in 2021, if you take a look at S&P 500 companies, you will see that, hey, top 5 companies are tech, FANG companies, AAANG companies, and they make up approximately 20% weight in S&P 500. And these companies are extremely volatile, right? They will go down fast also and they will come up fast also. And that is what precisely happened in the 2020 Corona crash as well. The tech stocks got hit very hard, finance stocks got hit very hard, and they were the first ones to bounce back and make new height. Now going forward, so for example, let's imagine a scenario that we are sitting in somewhere around 2030. what will happen? When the bear market happens, the likely scenario, or my estimation is that the likely scenario would be that there might be like a 60-70% correction also. But this correction will bounce back once the bear market goes away, right? So please keep this in mind. This is the first key prognosis that you need to take away from this discussion. Very important for you. If you like the analysis, do press the like button. Now, the second key point that you need to understand and remember from a bear run discussion is that how do people usually react in a bear run? So essentially, there are two types of investor in a bear run, right? One would be novice investor who have just recently started in the stock market. Their initial reaction is that, hey, let me pull out all the money which I can because the economy will become zero going forward, right? That is what they would imagine. This is precisely what happened in 2020 Corona crash also. You would have seen that people withdrew a lot of their money from mutual fund investments. They stopped their SIP and they were just waiting on the sidelines for this market crash to get over. Now, when market crash actually gets over, it rises so fast that you're not able to catch back and get back on that investing bandwagon. It sounds very simple, but you're not able to do it. Now, why is this strategy wrong? Why you should not withdraw your money during a crash, or why you should not stop your SIP during a crash? The reason is very simple, and I had done a separate video on dollar cost averaging. You can check it somewhere here. I've explained the entire concept, but I'll explain it again very, very quickly so that you don't miss this important point. Now, dollar cost averaging simply says that you periodically, let's say that you pick a random date, let's say 14th of every month, you go and invest whatever money you want to invest in the stock market. So let's say that you invest your money here, right? So you're investing 10,000 rupees. Hypothetically. Then you put another 10,000 here, then you put another 10,000, 10,000, 10,000. All these red dots indicate what? 10,000, right? Now, what can you see? That in the long run, this market is going up, right? This trend line is up. So this is clear. So you will not lose money, right? So you are putting your money at every 14th of every month. Now market can go up, market can go down, market can do whatever. You are still putting your money. Now when the market is going down, will you be able to buy more units or less units? So let us understand this. For example, let's say that you are sitting on this point A, right? Market is down and you are putting 10,000 rupee as the investment amount. Now will you get more units here of the stocks, or will you get more units here? You will get more units at point A. Why? Because the market is down, so you can buy more of that good. It's like that apple prices were 100 yesterday, so you can buy fewer apples. Now the apple prices have come down to 80. Now you can buy more apples. So as long as you keep investing the same amount, that averaging will happen. So therefore you should not stop your SIP or withdraw money from the stock market, because you don't know when the market will start climbing back up and you will miss that bandwagon entirely. So you should stay invested even in a bear run, and you should keep on continuing with your systematic investment plans because of dollar cost averaging. This is a very important concept. People miss it, especially the novice investors, and that is the reason why so many retail investors took a loss in the stock market during the bear run. During the bear run, you're not making money. What you're simply trying to do is that you're trying to avoid exactly the mistakes like these that I've been speaking on this video. So I hope this makes sense. Now you would say, Akshat, you know what, it looks like very scary, because if I'm sitting in 2020, I just invested my money here and the share market came down. So if I had invested like, let's say 10,000 rupee, I was only left with like 5,000 rupee here. So couple of points for you. Number one, so it's not as if that you're taking a loss. I can't stress on this point enough, that it's not as if that you're taking a loss. You only make a profit or a loss when you sell your share. So this is not a loss, so please don't term it as loss. That's point one. Point two, the market has always come up. Always, right? For example, so this is the 2008 crash. Market came down, it went back up. 2020, it came down and it went back up. In fact, it is still going up and up. So the bottom line is that, see, you need to understand that you're not making a loss just because your invested amount has become from 10,000 to 5,000. That is not a loss. That will come back up if you are invested in fundamentally good stocks. And number two, that market always finds a new peak. For example, currently we are trying to hit 18,000 as Nifty. Now, do you really think that 18,000 will be the cap? It will never move beyond 18,000. I can guarantee you that Nifty will definitely hit above 18,000. It might hit 20,000. When it hits 20,000, will it never go to 25,000? No, it will again go to 25,000. You might ask me why. Can you explain me the fundamental reason behind why Nifty will always create a new peak? Now, Nifty will create a new peak for two reasons. The first reason is that the world survives on growth, right? As the growth is happening, the GDPs will keep on expanding. As GDPs keep on expanding, it indirectly means that the companies are expanding. It means that the companies are making more profit. Their share prices are increasing. That is getting reflected on your portfolio. So this growth concept is very much alive. If for some reason you believe that going forward, the world will not grow, it will rather shrink, then you are right that we will forever stay in a bear run. But if you believe that the growth will happen, then the Nifty will move from 18,000 to 19,000, from 19,000 to 20,000, so on and so forth. It has to happen. Now, what is the second reason? The second reason is a more fundamental reason. Now, what happens is that there are foreign institutional investors, DII. They are the ones who actually control the market. You would say that no, Akshat, actually retail investors also control the market. I read some reports. They say that there are 40% retail investors. True, but Mr. Rakesh Jhunjhunwala is also a retail investor technically. So these are HNIs, right? They are somewhat lumped into retail investors, and we assume that retail investors run the show. No. FII, DIIs and these HNIs, they run the show, right? Now, how will they make money? Will they make money if the market is shrinking? No, right? Let us understand this from an example. So DII, domestic institutional investor, will be companies like HDFC, AMC. Now, why would you keep on putting money in HDFC, AMC if you yourself are not seeing any growth in your money? You might give your fund manager a leeway of 1 year, 2 year, 3 year, 4 year. If your fund manager is not giving you returns, if he or she is not turning your 10,000 rupee to 12,000, 15,000 every single time, why would you give them the money? You will simply withdraw it. You will say that, you know what, this person does not know anything. I have to grow my money. Yes, it's true that they might not want to increase your money at a rapid pace, right? Give you like 20% return each year. That is by design. We will talk about it on some other video. But the bottom line is that your fund manager's business thrives only by giving you return. So they have to grow your money, and for that, they have to pull the Nifty up. That is it. They have to pull the market up. They have to pull the Nifty up. So the markets will always keep on creating new peaks and new heights. Now, a very funny argument that people make is that, hey, you know what, Akshat, what if the economy crashes? For example, there was this COVID crisis and the stock market went down. We don't know the realities of the economy. The economy might shrink. It might do like really bad stuff in the economy. We don't know to what extent this ravaging will happen, and the world itself might go bonkers. So what happens in that scenario? The stock market will definitely be crashed, right? It will be done and dusted. So Nifty will come from 17,500 to almost zero. So let's imagine this hypothetical scenario that Nifty actually comes from 17,500 to zero. Everything is done. What does this mean? This means that all the companies that make up the economy are gone, right? Companies like HUL, Nestle, this, that, all are gone, right? Nothing left. Your banks are gone. HDFC, if HDFC stock price is zero, so let's imagine that you have kept like 15 lakh rupees in your HDFC bank account. Now, HDFC share price, if it hypothetically goes to zero, do you think you are going to get any money, right? Which is kept even in your fixed deposit. Are you going to get any of that money back? Answer is no, right? It sounds scary, but no, you will not get any money back. So if such a scenario happens that there is some nuclear war and the Nifty literally like boils down from 17,500 to zero, if the world is going bonkers, then honestly, no matter where you are keeping your money, be it in cash, be it in gold, be it in anywhere, there will be no transaction happening there. A great case study here would be Venezuela, that there was a currency crisis, that people were spending millions and billions just to buy a loaf of bread, right? There were bank runs, government was going down, institutions were going down. This entire thing has been encapsulated during the Venezuelan currency crisis. So the bottom line is that if something disastrous happen in the economy, it's not just as if only the stock market will go down. Everything along with it will get annihilated, right? So don't believe in that doomsday narrative. Be sensible, be realistic. Such things are unlikely to happen, and honestly, if it happens, it is beyond us, right? Candlestick analysis or fundamental or business analysis are not going to help you save any money from that perspective. So now your question would be, okay, great Akshat, what is it that you would advise us to do? And more importantly, what did you do during the 2020 Corona crash? How did you handle that bear run? So my strategy was very simple. I was sitting on good stocks. Those stocks corrected by 40-50%, sometimes 60%. For example, I was holding Bajaj Finance stock, right? I was holding it at 4,800. It went down to literally like 2,000, right? So there was like almost a 60% correction on this stock, massive correction. Was I sitting on a notional loss? Yes, I was sitting on a notional loss on Bajaj Finance. Did I sell it at that point in time? No. If you ask me why, that why did you not sell Bajaj Finance stock? Because it's a high beta stock. High beta stocks mean that these stocks will show massive volatility. Massive volatility. I knew this at the time of buying the stock itself. So if the stock market or the entire Nifty is correcting, of course a stock like Bajaj Finance is going to go down. In a bull run, a stock like Bajaj Finance is going to do well. And that is precisely what it has been doing. So don't sell your fundamentally good stocks. That was the first thing that I did. That Bajaj Finance was a fundamentally good stock. HDFC was a fundamentally good stock. HUL was a fundamentally good stock. I did not sell any of this stuff. Now you would say that, Akshat, you know what? Okay, you are talking about like Gade Murde, right? That you did this in 2020 crash, this, that. So can you name some fundamentally good stocks now? If bear run happens, I will not sell those. Okay. Bajaj Finance, HDFC Bank, HUL, Nestle, Dabur, Colgate, all these are fundamentally sound stocks. So you don't need to sell it. In case you have these in your portfolio and if tomorrow bear run starts, you don't need to sell any of this stuff at a loss. Now this is from a long-term perspective that I knew that stocks like Bajaj Finance will come up. What about short-term? In short-term, you must be aware and you must modulate your small cap and mid cap positions, especially on high debt companies. Now, if you feel, right, and this is what even I am doing, especially the companies where the debt is high, for example, something like Bharti Airtel, right, the debt is high. Right now we are in a bull run, so I'm not selling it off. I'm going to sell it off in a few days, but I know for a fact that if a bear run happens, that companies like Bharti Airtel, because they are high debt laden companies, they are going to take a lot of hit also. But I have very few stocks which have high debt in my portfolio. I advise against buying high debt companies, so you should not have it in the first place. But if you have it, then you should rationalize and optimize during a bear run. That is very important. Now you would say, Akshat, you know what? You also talk about swing trading. So what about swing trading? Okay, so you must always swing trade on fundamentally good stocks. Now there were a lot of stocks that I was swing trading on. I always keep swing trading a few stocks here and there. I was swing trading a few stocks back in March of 2020 also. I got stuck with those swing trading stocks, but since they were fundamentally good stock, I just converted those positions from a long-term investment position. So instead of selling them off at a loss, I held on to them. When the market went up, I sold them off. So the bottom line of this entire discussion or the summary here is very simple, that market is always going to make its new peak. Why? Because economies will grow. Right? So even if the bear run happens tomorrow, stay put, stay relaxed. You don't need to worry. That's first. Second point, as long as you have picked fundamentally good stocks, if you do swing trading on fundamentally good stocks, if you do long-term investing on fundamentally good stocks, you don't need to worry about. On the flip side, if you have high debt companies, if you have highly volatile stocks that you don't understand, you have just bought on rumors, then you are in trouble and you need to lighten your position. Now would be the good time to sell some of the bad stuff from your portfolio and rationalize your position and pick only fundamentally good stocks, because the bear run can happen at any time, right? No one can take a guarantee that it will only happen after 5 years or 10 years or 5 days from now. No one knows it. So be prepared, be alert and be a smart retail investor. That is how you are going to make money and achieve financial freedom. So I hope you enjoyed the video. Give it a thumbs up and let me know what other videos you would like me to make.